Hello and welcome back to Fen 340 Real Estate. Today we'll be discussing chapters 12 and 13, and this is lecture 2, part 2. Alright, the general overview of chapter 12 and 13, Truth in Lending Act and the Loan in Application Approval and Predatory Lending are the concepts that are covered in chapter 12. And then chapter 13, there's primary and secondary markets, loan programs from those markets, the lenders and brokers involved in those, and two large institutions as well as two other ones, Fannie Mae and Freddie Mac. So chapter 12 is the truth in lending, and it really has to do with regulations regarding lending and mortgage practices. With the Truth in Lending Act under the Federal Consumer Protection Act, also known as the Truth in Lending Act, in 1969 they enacted this in order to protect borrowers from predatory lending practices, and this usually had to do with both mortgages and consumer credit or credit cards. And the purpose of doing this, again, is to make sure that when people borrow money, they know what they're exactly getting into. So before, we may have given you contracts which had interest rates that were written in a simple annual rate, but not a compounded rate, so you didn't really know what you were borrowing at. So they may have been compounded daily at 20%, for example, and that's going to end up being a much higher actual interest rate that you're going to pay if we don't disclose to you the compounded rate. Or there may be loan sharks who compound daily rates, but at 50%, which actually ends up being quite significant of a difference. We're talking 5 to 6% more interest in the compounding effect. And then also charging fees on top of that and not disclosing the fee schedules to people ahead of time. So then you found out after the fact that you violated a covenant, and here's this enormous fee that you must pay. So this led to people getting loans that ended up causing them to go bankrupt or lose all of their money. So the banker basically took all of it. So the Truth in Lending Act was put into place in order to regulate the banking side of things and make sure that consumers were protected as far as information share between what consumers don't really generally know about banking and lending and the lenders who know everything they need to about lending. So it's kind of evening the playing field between lenders and borrowers. So the areas that it covers are advertising, required disclosures, the disclosure of the annual percentage rate, disclosures in lending, those finance charges that we discussed, and the right to rescind if any of this is done incorrectly. So in advertising, the truth in lending basically requires, as many of you may know from general law, you can't really lie in advertising anymore. And the same goes for lending. You cannot advertise specific rates that you're not going to offer, or you cannot advertise availability of loan credit that is then very difficult to get. Okay? So this is general advertising. You have to be truthful in your advertising that you're going to provide to people, or you simply just cannot advertise at all. There are also required disclosures that everybody must make in their lending practices. So these required disclosures usually require us to say the amount that's going to be financed, the finance charges, the annual percentage rate, and the total of the payments that will be made. So you can figure out total of the payments as the sum, and then subtract the original balance that you were going to pay. The difference between that is the total interest. So giving these 4 items in the disclosures tells you all that you need to know in your borrowing for the transaction. Okay, so who must comply with these rules? Well, basically any lending institution has to comply with these rules. Anybody who's going to be giving money away for the purpose of consumers, not bank to bank, that's very important, but to consumers, have to comply with these rules. And this includes private individuals as well. That doesn't just include banks. As long as you will be lending to a consumer who has less understanding than of a regular business entity or individual, you must follow the Truth in Lending Act. And this is why private lenders often get in trouble, because they don't think they have to disclose this information. Now, the annual percentage rate that we have to disclose, that includes not just disclosing the simple interest, but also the compounded interest. So you have to tell the borrower, this is the small amount of interest you're going to pay in the simple terms, and here is at the compounded rate stated in this loan agreement what we will end up paying in actuality. And that is, again, to keep people from borrowing at what they think are low rates, and then due to compounding actually end up paying more. The additional thing is the finance charges. So you might wonder, well, why does finance charges matter? Say you were to borrow $10,000 and somebody gave you a finance charge of $500. You say, okay, well, that seems reasonable. They have to do some footwork and I need to pay them for that footwork. They're going to transfer the fee to me. That seems pretty much a very capitalistic thing to do. We're going to continue with that. Well, the unfortunate aspect of that is that 5% of 10,000 is a pretty large percentage. Okay? It's 5%. So if you don't sit there and you do the calculation, then you don't automatically think that you've paid already 5% interest on the loan just with the finance charge. That adds on to the original interest that you had. And that 5% is immediate, so depending on the life of the loan, it could actually be more of that. So if the life of the loan is less than a year, then it's not 5% per year. Let's say that the loan was only 6 months, then you've actually paid 10% per year in the finance charge. Okay? So now you can begin to see how loan sharks can be a very devastating item to rural areas where they tend to be, or urban areas which are poor, where loan sharks still exist in the South, for example. They simply charge a high finance charge under a short-term loan, and that multiplies the effective interest rate that exists there. So again, it goes back to that disclosing that effective compounded interest rate, and that includes the finance charges. And if any of this material is not done correctly, the borrower typically has the right to rescind the loan. The borrower has the right to rescind. That's very important. So if the bank or the lending institution or private entity don't give all of these disclosures, then the borrower can say, I no longer want the loan, even though I bought the property with it. I'm not going to pay on the loan. And the bank will probably try and sue, but they will lose in court for failing to follow the Truth in Lending Act. So recently, because of the plethora of institutions which deal with lending, Fannie Mae, Freddie Mac, FHA, and the Veterans Association, they all needed a clean and easy way of dealing with loan applications and information that is required to be disclosed on loans. So before the 1980s and 90s, they didn't have a good agreement on what would be required. So the VA would ask some information, not all the same as the FHA, and the FHA would ask some information the VA didn't ask. And Fannie Mae and Freddie Mac would have to try and deal with either of them and try and go, well, what do we have information for? Is this enough information for us to underwrite the loan? Maybe yes, maybe not. And then they got together and decided, well, we're going to unify this and form the Uniform Residential Loan Application, which pretty much says you will provide all of this information in the loan application, and it's going to be standard, and everybody's going to get the same information. And this will allow all the banks to use the same information in their underwriting process. The underwriting process is figuring out what interest rates do we charge to individuals on these mortgages, and should we give them a mortgage at all, or are they too risky? So this is a very nice little feature. It will ask you, where are you getting the money to settle your funds? Okay, where's it coming from? Did you save that money? Are you borrowing it from your parents? Are you getting another mortgage to provide the money to make a down payment for this mortgage, which used to be common, but you cannot do it now? Okay, so they try to ask, where are you getting the money from? What is the purpose of this loan? And it's very interesting that if you do not disclose to the bank appropriately your point in doing the loan, they may decline you. So if you say, I am going to get this loan in order to buy the house and live in it for 30 years, maybe refurbish it, and if the markets are appropriate, I will resell it later, they are more likely to give you that loan than if you said, I am buying this house for the purpose of renting it out. Because it's actually more risky to be a landlord than it is to live in the property. So giving them the purpose of the loan correctly may or may not lead you to getting an acceptance or a decline. It's very important to follow that point. You may also be, saying a little, I'm just going to get this loan for like a year. I'm going to speculate in the housing market. I expect prices to go up. Well, they don't always go up. And the bank knows that. So they are probably going to decline the loan because they think you're not taking the loan for an appropriate reason. Then they'll go on to a section that deals with borrower analysis, and this has to do with your credit reports and how much money you have and what have you disclosed as far as your assets and liabilities. So they go on to your monthly income, and roughly about 25 to 30% of your monthly income before taxes, the gross income, can be used to pay for your mortgage. and a total of 33 to 38% of your fixed expenditures from your discretionary income can exist. So what does that mean? If we had about $1,000 a month in gross income, which would be quite low, but we can go with the number there, we could spend $333.33 approximately a month on our mortgage. Okay, not very much, or 300 if you're going to use the 30% rate there. Okay, not very much, but most people are going to earn between $3,000 and $5,000 a month in gross. Okay, so we can reach about $1,000 easily in order to pay for a mortgage. So that is why most homes today run mortgages between $700 and $1,400 in mortgage payment per month, because that's what's affordable to most Americans. Keep in mind that as of 2018, the average American family made $62,000 a year. Okay, so about $5,000 some dollars a month. As a family, mind you, not individual couples together. That's together all told. So they can afford about $1,400 a month as far as their mortgage expenses. And that's where the monthly income analysis comes in. The rule park of thumb there is 1/3 of your disposable income, or one third approximately of your gross income, can be used for your mortgage expenditure, but not more. And then they will ask for your assets and liabilities. This is done in order to make sure that your balance sheet isn't overheaded with too much debt with regards to the assets. If they find out that you have too much debt in the form of credit cards or car loans or student loans, more than the assets you have, then they are likely to decline you for a mortgage application, because they feel adding more debt to the fire will make you even more insolvent. And so they have no purpose in taking that risk. So if you're going to make the loan application, you have to show more assets than you have liabilities. Particularly for students, this is a bit of a problem if they've got a lot of student loans, because the student loans show up directly as a mortgage balance. Now, what most banks will do is, instead of including the student loans in your liabilities section, they will look at it under the monthly income section. And they will assume 1 to 1.5% of the outstanding loan balance is used as a monthly payment. So if you have $100,000 in student loans, they will use 1 to 1.5% against your monthly income. So that means $1,000 to $100,500 against your monthly income. So if we go back to the individual's couple who made $5,000 a month in gross income, they would take off $1,000 to $1,500, and that's what would be used left to compute the balance for what they could afford for a mortgage. So let's use that number there. We'll say $5,000. We take off $1,000. We're at $400. Okay. This couple can pay 33% approximately. Let's just use the 33% there of the 4,000. Okay. So what does that take us up to? Okay, we're going to be fine at $1,200 a month in mortgage. That's how much they can afford. Okay, which will get them a pretty decent house, maybe $250,000, $270,000. Okay, it's not going to be a bad living for them. They can afford a house in most areas. So that's how they would do it. They would take your student loans. They would acknowledge that you have them there, but because student loans are not defaultable, they will move the balance of the payment into the monthly income calculation and pretty much ignore it for the assets and liabilities calculation in determining whether you are solvent or not. However, if you have more credit card debt and car loans than you have physical assets, typically cash or stocks and bonds, then they are going to decline your application, regardless of your student loans. So you have to make sure you have enough cash on hand. Life insurance. This one is very interesting. Most people are not going to think about it. Will the bank want life insurance for you if they're going to give you a loan? Well, they would like it. If you die, okay, your spouse may not be able to keep on payments, or perhaps you don't have a spouse. And if you die, then who's going to pay for that mortgage? It may have to be sold, and sold quickly, and which usually means that it's not going to get market value. And the bank may end up losing money on that transaction. However, if one of your relative earns a life insurance policy from you and they can inherit the property, provided they accept inheritance of the property, then they must also pay the remaining mortgage balance. And if they've received life insurance for more than the value of the mortgage balance, then the bank will be happy to net the mortgage balance to zero and give the remaining individual, your surviving spouse possibly, or surviving relative, the property without any balance on it. That's why they would like life insurance. So you're often required to disclose life insurance. So it is very easy today for most of you, because you're quite young, to get a life insurance contract immediately, which will cost you less than probably $100 a month, and you can insure yourself for about $1 million. Most of you will not get $1 million house initially coming out of college, so that's going to be more than enough money to insure your mortgage. And again, it's not going to cost you a lot, predominantly if you don't smoke and you don't have any other life-causing or illnesses that exist. Life insurance is not that expensive for young people, and you can get term insurance if you want of 30 years, which would match you exactly to a 30-year mortgage. Very cheap, will lower your interest rate, so keep that in mind. And they also want to make sure your net worth is positive or negative. If your net worth is negative, as we said, you have less assets than you have liabilities, you will be declined. If your net worth is particularly high, which means you've got a lot of assets relative to your liabilities, they may lower your interest rate because they view you as a credit-worthy lending applicant, even if you do not have high monthly income. If you have high net worth, which means you've got more cash in the bank than you have debt, then you may be able to lower your interest rate without a high income. Okay. The last thing they'll ask is for references, and this comes up in two ways. So the references are usually to call and ask, are you a good borrower? But you usually list a previous landlord as one of those to give the idea that have you ever missed a rent payment, or have you ever been late for rent payments? And the previous landlord will say yes or no. And if they say you've been late, then you may get declined for the loan. And they may also list references to various other entities who may be able to determine or give reference to the bank as to how you are as a borrower, and how trustworthy you are. The other reason they do this in reality is that they now have 3 people who they could contact to get a hold of you if you decide to stop responding to them. So be very careful who you place down as references. Nobody likes to get calls in the middle of the night because you haven't been paying your mortgage. Okay? So if you are going to put down people for the references, you need to ask, obviously, beforehand about putting down the references. Do not put down references that you have not got approval for from that individual. It's a very bad idea. It's very rude. I knew one professor once who gave a reference to a guy because he didn't even remember the individual. The guy just put him down as a reference. He actually defamed the guy in his reference to make sure that he didn't get approved. So be very careful about what you do with references and who you ask. Predatory lending. Okay. These are the practices which lenders do, which are dangerous to borrowers. Okay, and then we also have some methods of doing predatory lending and mortgage fraud that we're going to discuss here. But predatory lending are practices where the lender has more information than the borrower. Okay? And they're basically going to try and take advantage of the borrower. And those are the items we talked about before in the truth of lending, where they're going to do transactions in a way which would not benefit the borrower, but only benefit them. So they may charge a high interest rate in the hopes that the borrower doesn't know that compounding it will cause it to be even worse. Or they may put fees, hidden fees in there. If you pay with a check, for example, I just recently saw in a lease agreement, if you pay with a check, we're going to charge you $25 to pay in the check. That's a lease agreement, but it could happen in a predatory lending agreement. Okay. Well, it's very difficult to pay your bills if you have to pay $25 every time you write a check. So keep these in mind and always read your lending agreements in full. And if you're not good at legalese, hire a lawyer. Okay? And here are some examples of common mortgage frauds. Okay? The flip is one example of a mortgage fraud where an individual is going to get a property appraised. And so they're going to try and sell it from person C, who is a legitimate seller of the property. Person B is a fraudster. They are going to agree to buy the property from person C. Okay. The real property value is, as your book says in this example, $400,000. But buyer B is going to sell it to some buyer A for $600,000 because he's received an appraisal from probably his friend who says the property is worth $600,000. So buyer A is none the wiser and thinks that buyer B owns the property, but he does not. Instead, owner C has the property still, because buyer B has agreed to buy it from owner C, but has not closed the deal. And buyer A has agreed to buy it from buyer B, not knowing that buyer B does not own the property. They don't have title. Okay, so what's occurred here is that buyer C offered for 400, buyer B bought for 400. Buyer B immediately turned around and offered to buyer A for 600 under a new appraisal. Nothing has happened as far as B is concerned. He's done no work. In fact, A could have bought from C for $400, but B has just simply raised the price by $200,000. Okay? And they strike the deal, A and B. A acquires a mortgage loan for $600,000, transfers the money to B under the escrow. B takes the $600,000 and pays $400,000 to buyer C, takes to possession of the title, and within the week time, transfer title back to A. It seems as if nothing has happened here, except for B has now netted $200,000 and done no work except for take hold of a title and transfer it to person A. Okay? This legally should not happen. It's not supposed to be possible, because when the buyer A goes to close the transaction with buyer B, okay, the bank should ask for possession of title from buyer B before they make the mortgage. But they don't check, or the escrow closer doesn't check, and he knows that buyer B is doing this transaction, or he may be in on the transaction, he's going to get a kickback from it. So he goes ahead and forces it through, or goes outside of the banking system to write it manually. And that allows them to get around the auto check that would require for the deed title to be available in order for the mortgage to be funded. And this allows the upright of $200,000 on the property that wouldn't otherwise be there. So always, if you're going to buy the property, make sure that you have access to the title and the deed, and that nobody is trying to flip you on that property. Another one which may occur, it's called the switcheroo, or the old switcheroo, or the old switch, where they basically will just write up the appraisal value of the property in going to the bank. So they purchase the property for $400,000. They get an appraisal for $600,000. They go to the bank and they get the appraisal right up for that value, and then they move on to the next transaction, typically defaulting on the transaction. And they may even set up a sub-entity to do this. So a Schedule S Corp or a C Corp, which is its own legal entity, buy the property, get the appraisal write-up, take the $200,000, distribute it to the owners through a dividend, and then bankrupt the company. Okay? So now the owners take that money, they move on, they can even change states, very hard to follow them, and they go set up a new company and they go do it again. And they do this a few thousand, like 5 times, and they've got $1 million. Okay? It's not hard to pull off the switcheroo, because it's just a reappraisal. And the appraiser is going to be in on the deal because they're going to get a cut of the money. The escrow closer is going to get a cut of the money, and the person doing this is going to take the largest share because they're at risk. It's pretty hard to find the old switcheroo. That's one of the most prominent lending fraud acts that exist today. So that's ones you have to be on the lookout for, but you as the lender have to try and find it. Okay, everybody else is pretty much involved in the deal there. The contractor scheme is where an individual buys the property, then they go set up a contracting company. They offer a bid to the owner, which is themselves, for $200,000 of construction work. The owner of the property takes this notice to the bank, and they say to the bank, I need $200,000 of money in order to improve my property. Here is the bid I have received from my contractor. Remind yourself, the contractor is the same guy asking for money here. The bank says, okay, that seems like a legitimate corporation. They don't bother to check any of the actual owners of that corporation. Here's $200,000. Enjoy your remodeling. And the individual takes the money. They do no work on the property. They may then leave the property, sell the property, and skip town or just hold on to the money and pocket it and wait 30 years for the property to revalue and sell it at that point. Okay, that's called the contractor scheme. So basically, trying to say you're going to do work, getting money for that work, not doing any work, and then quietly leaving the scene. Okay, that's a pretty common scheme as well. So be on the lookout for that. Again, it's a lender's thing where you have to figure that out if you're the lender. The ultimate lie is where the individual lies completely on their application. They lie about their money and their income, their assets and their liabilities. It is generally very difficult for the bank to go figure out if what you have declared on the assets and liabilities is truthful, particularly the assets. The liabilities is easy to find, it's on your credit report. But how do you verify assets? Well, they can ask for bank statements, but what about the value of your car? What about the value of your other properties if you have other properties? You can have a friend appraise them if your friend is an appraiser and you're in the real estate business. And if they appraise a property which is really only $10,000 and they appraise it for $1 million, you can get away with a lot. Okay? So that's the ultimate lie, lying on your actual document. This is found out when you default on the property and the bank goes to foreclose. They don't get the money in their foreclosure, and we enter into the deficiency judgment that we talked about in prior chapters. The deficiency judgment is held against the individual personally, and they go to seize the appraised property for $1 million, only to find out that it's worth $10,000. And that's when there's no money found in the individual, and the bank has to eat the loss on the loan. Okay, so that's the ultimate lie scheme. The innocent investor is one that you have to be pretty careful about. The lenders will, or in this fraudster schemers here, they find a guy who has just come into money, maybe young, has a pretty good job, or maybe just immigrated over from internationally overseas. And they say, well, if you take this money and you invest it, I can set up loans for you for a house, and I can rent it out for you then, and I will manage that property, and all you have to do is sit back, relax, go to the beach, and get rich. The unfortunate thing is they do half of what they plan to do, or they tell you they're going to do. So they go and find a house for you. They get that house appraised for more than it's worth. They sell it, they purchase it, and they get a mortgage for more than that value, and they pocket the difference. So they give you only equity in the house for what you put as the down payment. They pocket the difference between the actual value in the house and the appraised value in the mortgage. They then offer to rent out the property for you, and you make mortgage payments until they get a renter. The unfortunate thing is at this point they are done. They leave. They take the $200,000 of the write-up of the appraisal and anything that you may have paid them to do, and you are left with a house that is not going to be rented, typically at payments which you cannot afford. If you default on that mortgage, you are personally liable because you allowed the individual to act as your agent. They were your employee, and therefore they can bind you contractually to any agreement, provided that's what you let them do. And they are not responsible for any damages which you suffer because they are your employee. You cannot sue your employees for damages, okay, unless there was gross negligence there. And you would have to try and prove fraud in the criminal market, criminal courts there. So it's pretty difficult to do, so be very careful about this. If it smells too good to be true, that's the easy way to know that you shouldn't do it. It's not easy to become rich in the real estate markets overnight. You have to put in your own equity, your own work, and that usually involves buying houses which you find at cheap value, fixing them up if necessary, and renting them out on your own. So always do the footwork yourself. You'll save yourself a headache and probably the fraud scenario of the innocent investor. The trust me is a pretty nefarious one. Basically, this individual comes along, typically to old people who can't afford their mortgage anymore, or young people who are facing bankruptcy, and they say, look, I've got some money. I will buy the house out from you if you transfer it into this trust fund or trust entity that I've got, and you transfer your beneficial interest into this third individual. So I'm going to take physical property rights over your property. You're going to become a leasee of the property for life, effectively, provided you make substantial and sufficient monthly payments, which we've agreed to. I will allow you to live in this property, and if you sell it, we'll give you the proceeds on top of what you owned, your portion pro rata, that you transferred beneficial ownership to the trust. Okay, sounds great. All right, you're going to get out of your mortgage. You're going to put it into a trust. It's going to be protected. The government can't get at it. The bank can't get at it. You're going to be able to live in it. And all you have to do is keep paying this individual what you would have been paying the bank. So you don't care, okay? It doesn't matter to you if you pay the bank or you pay this trustee. So you're happy to do it because they're not going to kick you out. You got a lifetime right until you miss a payment, okay? And when you miss a payment or you break the covenants that are in the trustee document, they then inform you, unfortunately, you no longer own the property. The trust does, and try to sue the trust because the trust's ownership rights are ironclad. That's how trusts work, okay? Trusts are designed solely for the purpose of being unsuable by the government and other entities. That's their whole purpose, okay? Very, very strong ironclad ownership rights. So now you don't own that property and you cannot get it back, and they inform you, too bad, so sad, you're now asked to leave the property, and they can then, as trustees, sell that property at a profit, and if they are beneficiaries of the trustees, enjoy the proceeds of that. Okay, so that's the trust me fraud event. So be careful of it. Just don't agree to transfer anything to a trust unless your lawyer is acting on your behalf to transfer items into a trust which are revocable, which means you can undo it. Okay, only do irrevocable trusts if you have a very good reason to do it, and your lawyer and possibly another lawyer have agreed that is a good reason and they're acting in your best interest. And you also make sure that the trustee is your best friend, not a relative because it has to be arm's length, but your best friend, not the lawyer. Lawyers will often want to be trustees, okay? But if you make them the trustee, then they may be acting against your interest. They now have a conflict of interest, okay? But if the lawyer's your best friend, then that's the best way to go. Okay. Look out for red flags in what is occurring. If it seems too good to be true, it is. If the value of the home is way above what it recently sold at market for, it's not a good deal. There's an appraisal error there. Okay. So if you notice, recently the market sold in 2017 for $300,000, and all of a sudden it comes up on market sale under a mortgage loan application for $500,000. Unless there's been a significant amount of construction, and you can find that in the licenses to construct. You always need to get a construction license, a contractor's license, in order to do construction. Unless you can find those, then there's no reason to assume that the property is just appraised in value over the past 2 years by $200,000. Okay, so there's a fraud going on there, and that's the easiest way to figure out what's going on. But if the numbers are not that divergent, it may be difficult to figure out that there's actually fraud occurring here. Okay, Chapter 13 discusses in brief the sources of financing in the mortgage markets. So there are two sets of mortgage markets: primary mortgage market and the secondary mortgage market. This is a lot like those of you who may remember primary and secondary stock markets, except for in the primary mortgage market, that's where lenders are going to originate mortgages with the borrowers. So they're going to give money to the borrower to get a house. The borrower is then going to make payments to the original mortgage loaner. Okay? The lenders in these markets are then going to want to get out of the mortgages. They're not really interested in making mortgages for the long term and sticking with that mortgage and owning it and just waiting for the payments to occur. What they're really interested in is getting the fees for originating the mortgage. Remember, we talked about the origination fees before. So that's where they make a loan, okay, and they get to charge you for making that loan because they got to do all that search and stuff. For the mortgage loan officer, that's their salary. So they're happy to make loans. If they could, they would make multiple loans every day because every loan they make $1,000, okay, or some number like that, right? So they have an incentive to make more loans. Well, how do they do that? Well, they need more money. Well, how do they get more money? Well, they take the loans they've already made and they sell them. And in the process, they take the money from those sales and they make more loans. And they always charge a fee. So they're in it to make fees. Primary mortgage lenders are typically in the game to make a fee. They sell to the secondary mortgage market, which are usually large institutions, investment banks, hedge funds, insurance companies, etc. okay, who are very happy to buy mortgages from the original lenders and accept payments on those mortgages either as a pass-through or a direct repatriation. Okay, we'll talk about those later when we discuss MBS and how that actually works. We're not going to do MBS this chapter. We'll mention it, but we're not going to get into it. So this is the secondary mortgage market. These are the markets from which the primary mortgage lenders sell to the secondary loan institutions. Okay, and they basically take back the money and they give new money to the primary market mortgage lenders, who then can give it to borrowers. So here's a little diagram of what that looks like. Again, the primary mortgage lending institutions give loans to borrowers who buy houses. Borrowers provide mortgage payments back to the primary mortgage institutions. The primary mortgage institutions are in it only for the fees, so they want to get rid of these loans. The secondary market institutions buy these loans from the mortgage institutions, providing a capital inflow, and the mortgage institutions pass on the payments to the secondary market institutions. Okay? And so this provides the flow of money from secondary market institutions, which are large depositors, investment banks, insurance companies, hedge funds, mutual funds, money market funds. Okay, all of these sort of institutions who then provide the money to the mortgage institutions, who provide the money to the loaners, who then pay interest and principal back to the mortgage institutions, who transfer it back to the secondary market institutions. And that's how the flow of money occurs. Okay? And in theory, eventually, because of how interest works over time, money should appropriate from the borrowers continuously over to the secondary market institutions. If we were to continue the circle down at the bottom, in theory, okay, I say in theory though because it doesn't work 100% this way, but in theory, the secondary market institutions should employ a large amount of people and they pay them a salary who are also borrowers. So the money should also flow back to the borrowers in the form of income. Okay? Doesn't really work that way though, as we know, because most of the owners of secondary market institutions are extremely wealthy individuals who do not need to borrow money to purchase real estate. Okay? They borrow with their own money, perhaps out of profit from the secondary market institutions. So it's not as if all of the money from the secondary market institutions' profits goes back to the borrowers. There's a large amount that simply remains in the ownership of these owners of the secondary market institutions. Okay, loan programs that exist for the purpose of providing money to consumers. Historically, it was savings and loans. Okay, before the large crisis, the savings and loan crisis happened, these banks would take deposits from consumers who would then give them out in the local community in the forms of mortgages. And that was their whole deal. They took savings and provided loans. And these were pretty efficient institutions. They worked fairly well until individuals figured out that, well, at some points in time, treasuries offered a better rate of interest than keeping your money in a checking book account or a certificate of deposit account. Okay? And when this occurred, an event called disintermediation happened. So this disintermediation is actually a process, not necessarily an event, but it happened in mass. Okay? And the disintermediation causes basically savings and loans institutions who have low interest rates on checking, people started taking their monies out of the savings accounts and investing them directly into treasury accounts and treasury bonds, which had a higher rate of interest. Well, if you start taking money out of the savings accounts and savings and loan institutions, they have less and less and less available money to loan out for mortgages, which causes interest rates on the mortgages to start to go up as the supply of loanable funds goes down. Okay, more demand exists for these loanable funds. So this causes a rise in interest rates, a reduction in the amount of loanable funds, and almost led to the collapse of the savings and loans institutional system. Okay, there had to be a formal reform of the institutions. Okay, had to kind of fix the system, provide liquidity into it to stop the savings and loan crisis from occurring. And then we had a formal redo of the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, which pretty much led to commercial banks taking over the majority of the mortgage lending market. So previously, commercial banks could not operate in both the investment side of banking and in the consumer banking side. Okay? They could not effectively, actively have offer mortgages, and also take deposits and investments from investors. Those were left through savings and loans. Okay, but as a result of the Financial Services Modernization Act of 1999, commercial banks now could offer one-stop shop banking for everyone. So they could take deposits and investments from large institutional bankers and investments from individual consumers and immediately turn around and give those as loans to individuals who are trying to get borrowing for real estate. So they became one-stop shops. And today, commercial banks have controlled the majority of the lending market. It's like 88% of the available outstanding market is controlled by commercial banks. And this Financial Services Modernization Act has been criticized predominantly by Elizabeth Warren, a senator from Massachusetts, for causing most of the problems we've had in the 2008 housing and 2007 housing market crisis. Okay, this what was previously separated under the 1990 or 1933 Financial Services Act, okay, to keep everything separated so that we didn't have runs in the banks, okay, and to keep the banks from trying to trade stock markets while also offering mortgages. This has been removed now, and the banks can operate in both markets, both in trading stocks and in offering mortgages. So the stock market goes down, now they need to recall their mortgages. And it's exactly what happened in 2007 and 2008. The stock market went down, the mortgage market was already not doing good, and it helped to lead to the systemic risk that was involved across the entire lending institutions. So commercial banks today, again, they offer most of the mortgages. We've had problems with the Financial Services Modernization Act, but overall it reduced regulation, and that helped to bring down interest rates, which is one of the reasons that commercial banks took over most of the lending market, because they had lower interest rates than savings and loans could provide. Okay, life insurance companies are typically one of the largest, and generally insurance at all, largest players in the loans programs, because all they're doing is taking premium deposits from individuals who have purchased their policies, and those premiums create what is known as float. Well, that float, that extra money that is not being called back in the form of proceeds for claims, okay, has to go somewhere. It has to be invested somewhere. And traditionally, insurance companies loved to invest in real estate because it was fairly stable and was a fixed income security. It is easy to manage an insurance company if you can forecast when you will have a claim. Predominantly in life insurance, that's pretty easy to do. When you'll have a claim and immunize, which means match, the time period of that claim, 80 years, to the time period of your income, fixed income. Okay? So I could say 30 years down the line, I would like to receive a paycheck from my mortgage investment in order to net against the potential claim that I will receive from this individual who bought a policy. So they use the float, they invested in real estate, and in 30 years they hope to get paid back enough money that if there were a claim, as they expect there will be, they'll be able to pay it. And all that time they will also earn interest. So that's the big idea there. They will earn interest. And that interest earned on the float is the profit to the life insurance company. Okay? So they're heavily invested in mortgage industries and mortgage markets. Mortgage companies are companies basically designed simply for the origination of loans in the mortgage markets. Okay? So these are companies that are simply trying to get everyone to have loans. They employ a lot of loan mortgage officers. Mortgage brokers, on the other hand, are interested in getting money from the secondary market and matching it to a consumer. Okay? Money from the secondary market, those institutions, insurance companies, and matching them directly to a consumer. So a mortgage company is interested in making those loans and then possibly selling them. A mortgage broker is interested in making the match between the secondary market institution and the borrower. That's the key. A broker matches people. Okay? All right. I think this is the last slide for you today. So we have 4 institutions here which are dealing with underwriting for loans. Okay? Federal National Mortgage Association, also called Fannie Mae. That's a common name that we use today. FNMA is the acronym, but we call it Fannie Mae. So the private entity, this is spun off by the government and now acts as a private entity. It used to be a public entity. It buys FHA and Veterans Association loans in the secondary market. Okay, so it's acting as that purchaser of loans and creating a secondary market. It can then sell these loans to other banks if it would like, but it is the largest purchaser of loans from the Federal Housing Association and the Veterans Association in order to make sure that somebody is buying these loans in the second market and providing money back to the original lenders. Okay? So just as we discussed, these are the individuals acting in that secondary market, in particular FHA and VA. So it's called Fannie Mae. In the conventional mortgage market, which are the individuals who are acting in loans which are not FHA and not Veterans Association, is the Freddie Mac. Okay? Again, they're buying loans from these people in order to act as the secondary market institution, but they are acting in conventional loans which are not, I should say FHA, not FMA there on the slides there, I apologize for that, which are not FHA, not VA. Okay? So these are the conventional loans, that's Freddie Mac. Fannie Mae is FHA, VA. Freddie Mac is non-FHA, VA. That's the key. Then there's Ginnie Mae. Ginnie Mae is the Government National Mortgage Association. It used to be part of the Fannie Mae institution before the government split them off. Okay? The purpose of the Ginnie Mae is twofold. One, to provide underwriting for low-income housing. Okay? We have a large amount of it in the United States where we need to provide housing to individuals who cannot afford it. They would like to buy houses, but they don't have stable income, or they don't have enough assets. So Ginnie Mae will back that loan. They also provide purchasing and mortgage-backed securities programs just like Fannie Mae, but the key here is that Fannie Mae is not a government entity anymore. It is an agency of the federal government, which means that it is chartered by the federal government, but acts as a private institution, just like, for example, the Federal Reserve. It is chartered by the United States government, but it is a private institution. Fannie Mae, being the same, is an agency, and so it provides agency assurance that the loan will be paid, but it does not provide backing by the federal government. Ginnie Mae provides backing by the federal government, okay? Full faith and credit of the United States institution. That's key here. So Ginnie Mae purchased MBS securities are far stronger than Fannie Mae purchased MBS securities. And in the collapse of 2008, Fannie Mae and Freddie Mac were two of the largest lending institutions which ran into trouble, along with AIG, in providing insurance and purchasing of the secondary market loans. Okay. And then the last one there, just the last offer, is the Farmer Mac, which is the, as we had talked about before, there are sometimes rural and farming institutions created. Farmer Mac is created for that same purpose. Federal Agricultural Mortgage Corporation, FAMC, for the secondary market in purchasing of farms and rural real estate, the same as those above, just in a specific rural market. Okay, that's all the material for chapters 12 and 13. We kind of switched out the order of things here. We will be moving on to chapter 14 next, and 15, which will happen in the next lecture together. Okay, so I moved 12 and 13 to this lecture. 14 and 15 will be the next lecture, and that will have actually caught us up. We'll have one less video than I planned in the syllabus for this week, but we'll have covered the correct amount of material.